happening last night, actually. Jolie Kent joins us now with the details. Joe, good morning.
Good morning, Sandra. Jack Dorsey's life is about to get way busier. After just a week after he was named the permanent CEO of Twitter, Dorsey is now gearing up for the IPO of his other company down the street, Square. The mobile payment startup filed its IPO paperwork after the close last night. And in that filing, Square disclosed it generated $850 million in revenue last year, but it lost $154 million. One of the risks mentioned in the filing, the fact that Dorsey will be running two publicly traded companies. Another company making headlines this morning, Netflix, the streaming giant, reporting third quarter earnings after the bell yesterday. The company's profit fell on higher expenses for content and expansion. Subscriber growth also slowed down from a year ago, and that came in below expectations. And partly to blame, the CEO says it's involuntary churn, new credit cards that had chips in them. So people can't really update their information as quickly as they want to because they're getting their new cards in.
I don't know. Ryan, are you buying this as an excuse?
It's sort of a concerning answer because if that was actually happening, loyal subscribers of Netflix would presumably go in and change their passwords and their credit card information so that they could continue watching.
And in Asia, they've been switching over to the chip for years now, right? And so that hasn't produced any involuntary churn. They have tons of international.
Well, Ryan, this is a blame the weather excuse. Like whenever a retailer kind of whiffs on sales in any given quarter, it's like, oh, it was the weather.
By the way, hold on 2 seconds, Mike, because I'm sorry, Ryan, I didn't even introduce you. Ryan Knutson from the Wall Street Journal is on the desk with us. But Mike, go ahead.
So I don't think Netflix whiffed. You know, Netflix brought on a ton of new subscribers. Reed Hastings had set the bar kind of high for this quarter. They came in a little bit below that bar in the U.S., but internationally they beat numbers. They're still expecting to bring on 3.5 million new subscribers this quarter. And look at the reaction of the stock last night when the numbers first came out, traded down to $93 in after-hours trading, and here it is this morning at $106. So if you believed in Netflix before this quarter, there's nothing here that makes you not believe in the company.
So, Ryan, I want to bring you in because I read your story in the Wall Street Journal on the train home yesterday. I'm like, wow, I feel like I really just learned something. I mean, the new media companies you've been looking at, like Vice Media, Huffington Post, and BuzzFeed, are getting into the TV business. I feel like I have to say that again because that's kind of the opposite of what we've been seeing as far as technology. The move would bring new revenue streams for each company. How do you see this working out? Is TV cool again or something?
Yeah, fascinating story by my colleague, but this is like a big growth area. I mean, these companies have huge valuations and they need new areas to grow. Television is a much more lucrative business. It's about $70 billion in advertising, whereas the online advertising market is only about $8 billion. So these companies need areas to grow. And also, traditional media companies are struggling at reaching new, younger audiences, so they're hoping that they'll get a hand with this.
Joe, I had to look twice at this story.
Yeah, well, also what's interesting is producing content now is not just a production company or a studio anymore or a big broadcast network. A lot of these companies are looking at creating their own content that would, maybe live on their own platforms, but also be very sellable. They're becoming mini studios. They're seeing what Netflix and Amazon have done that actually have huge payouts and can help the bottom and top line.
Vice is a multi-platform company, and they're kind of setting the standard in terms of distributing their content, whether it's on Facebook or via HBO. And even Netflix acknowledges that it's probably going to, they didn't say news business, but Vice is doing a daily news show. It's starting to do a daily news show on HBO. And so Netflix has acknowledged that it's going to need to probably follow doing documentaries.
I can barely keep up with it all, but the bottom line is that they're still seeing I guess they're still seeing a future in television because despite all the problems we talk about TV, the article points out TV is still a bigger business than online advertising. TV ad spending is forecast to be $70 billion this year compared with just under $8 billion for online video.
But I would love to know what direction that's going in because I would bet that TV is losing ground while online's gaining ground. And you look at all the new media companies. If you saw Thrillist Media last week had a big acquisition. So I think you're seeing a lot of the bigger companies looking to acquire some of the smaller companies and figure out a better way to get distribution. But I'd love to get your take on, I think the future will be online. Do you see it the same way?
It certainly is going in that opposite direction. But also, I mean, these traditional media companies are investing in these online startups. So, I mean, there's obviously some give and take here. But I think it really underscores the idea that good content is good content, and people will watch good content wherever it is. And these brands have big followings now, and so people will tune in to television to watch it if that's where there's going to be programming.
The one thing that Netflix says it will not get into is sports, because sports is real time
and expensive.
not on demand, and that's one area that they won't be touching. But we get hung up on like TV. Ultimately, it will be you have your apps, and you're probably going to pay for them, and you get to pick and choose. It's going to be a la carte, and you maybe don't need to have a box. Like I've got a projector and no TV, a projector and a Roku, and I've got my apps on the Roku, and that's it.
I mean, they just canceled like Outdoor Channel on our cable and the hunting channels and everything. My husband's just like, what else do I need cable for? So
and that's the one silver
cutting the cord,
huh? Well, for Netflix, I mean, they are investing in content, and so there's a lot of competition coming in. There's a lot of more options like HBO Now for people to watch.
Well, that's what I've said.
But the standard has to be high, right? Even if you're doing a brand new show, say on USA or another channel that isn't traditional, if you're not good, spending that money is a waste of time for the executives.
Well, that's what I've said is that you're going to see Netflix costs go up and the quality decline.
And that's what analysts are worried about at Netflix.
For crap, potentially. And that's where the business starts to kind of
Ryan,
what you're laughing at me because you love Netflix.
No, it's not that I love them. I think that they've managed to get this far, and I think Reed Hastings will continue to create good content.
Ryan, it was great to see you at 7 a.m. I looked at Ryan and I was like, what looks different this morning? He's like, it's 7 o'clock, not 6. So.
It's the extra hour.
The coffee.
More time for
the caffeine.
We always appreciate having you. And Joe, by the way.
Good to see you,
Thanks for joining us this morning. And we want to